Central bank interest rates are lowering, but the Sage Seeds AI seems convinced that it has noticed something about Connecticut. The 2020 pandemic had immediate and somewhat drastic changes to migration trends. Bankwell Financial Group, this tiny bank holding company, I say tiny, it only employs 144 people. These demographic changes, these different migration patterns post-pandemic are doing very interesting things to the financials. The Sage Seeds AI doesn't think the market has caught up yet. Stick around until the end to see the entire picture and what it looks like on the annual report. Let's dive in so that your wisdom can blossom.
This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice.
Starting our interpretation of the company's financials, under the profitability table, this difference between return on assets and return on equity begins to get me a little bit interested. At a basic level, just a simple structure for a bank, you would expect return on assets, return on equity, etc. to all be a lot closer to each other than this. Currently, return on equity is more than 10 times higher than the return on underlying assets. That has to be explained through some structural decision that the banking holding company made. Whatever funky banking structure this company has invented is allowing it to have a minuscule total asset turnover. That means very efficient use of its banking assets, as well as I would argue, somewhat staggering $1.36 million of revenue per employee. For a small-time bank with less than 10 or 15 branches or so, you would not necessarily expect to be seeing such a giant amount of revenue per employee. Under liquidity, the current ratio is very small. Something somewhere in the financials is convincing our AI that this tiny current ratio is totally okay and safe. Well, that's what brought me to this demographic table for Connecticut, where I quickly discovered that Bankwell might be benefiting from these migration trends far better than most financial services companies, or dare I say, most companies in general. And that could be the sort of context that allows us to be comfortable with a quirky regional bank that we probably would have never heard about otherwise if not for this recommendation. So to start from the very beginning, first we have to make sure we understand what are these changing migration trends in the first place? Well, here we have an NPR report. The now Commissioner of Connecticut Department of Public Health, Dr. Manisha Juthani, her personal experiences during the early days of the pandemic, very much on campus at the Yale New Haven Hospital. Connecticut's vaccination rate was one of the highest in the country at 95%. Now, a lot of that can be explained by the fact that University of Connecticut, Yale University, the Connecticut Health Foundation, etc., set up mobile vaccine clinics in churches, barbershops, and rural areas. But zooming it back to the present day, the interview ends with Juthani taking those initial emergency mobile vaccination clinics and essentially using them as beachheads to begin creating brand new full hospitals in several areas. Connecticut's public health system is in a much stronger position today, but the reason I'm bringing it up is that Juthani here has revealed major things as we try to understand the extreme migration trends happening in Connecticut right now. Connecticut was already filled with a lot of wealthy Democrats, but during and since the pandemic, these wealthy Democrats have felt entirely at liberty to start spreading their institutions across the entire state. I mean, she said it herself, they even went up to local neighborhood barber shops. Well-intentioned or not, if Yale University sets up a brand new clinic right next to the local barbershop, do you really think that community is going to stay the same 5 years later? No. And so coming from WSHU.org, we're going to get a purely economic lens on what's been going on in Connecticut over the last 5 or so years. Connecticut sees some of the strongest post-pandemic economic growth compared to the rest of the Northeast region. They're growing above the national national and New England averages. And people are calling this Connecticut's fastest economic growth in more than 20 years. Connecticut now being ranked as 19th in the nation in terms of GDP. Back in 2014, it was nearly dead last at 49th. That sort of bounce up from 49th in ranking to 19th in ranking is absolutely going to be related to the migration trends. So do not forget that this is the truth of what's going on in that state. Things like technology, software, and information industries are all growing nicely and becoming a bigger piece of the economic pie. In addition, the state has benefited immensely from federal policies to become the #1 manufacturer of aircraft engines, patents granted, and defense spending in the nation. Finally, Connecticut is also the only state in the Northeast region that has gained population since the pandemic. People are not only moving to Connecticut to live here, but they are starting their businesses here. We have a faster rate of startups than New York, New Jersey. That's all happening in Connecticut. Bankwell Financial Group investors have not really treated it like that is so different. Therefore, our Safe Seeds AI is starting to notice something being mispriced. But in our opening move, the first metrics we looked at described a bank that was inflating its return on equity relative to its return on assets by keeping a very low current ratio. That means efficiency, not growth. We're not looking for a growth story. We're looking for an efficiency story. And that's why we need to dig just a little bit deeper into these migration trends. We're going to have to look at what's happening to the seedier sides of Connecticut. And that's why in this next article, I'm going to show you that the poor people in Connecticut are being pushed out at a massive rate, especially relative to historical standards. Jonathan Parrilla stopped taking the bus a year ago when the state of Connecticut ended a year-long free fare program for Connecticut buses. He isn't the only one. Prior to the COVID-19 pandemic, one specific bus rider spent approximately $80 to $100 per week on public transportation. But in 2022, once the migration trend story had already commenced, the Connecticut Department of Transportation implemented a free fare policy using federal funds to encourage essential travel and, they say, mitigate financial burdens on commuters. The economic impact is not necessarily so straightforward. When you eliminate the financial burden on commuting, what you essentially do is encourage poor people to move away from the downtowns and into the suburbs where the cost of living is very, very cheap, especially when you don't have to consider the cost of commuting. As a result, from April to September 2022, there was a notable bump in bus ridership in the state. We can see very massive increases for this sort of thing. In all of the major cities, New Haven, Stamford, and Hartford all saw massive amounts of people leave the downtown and move to the suburbs. And I'm doing a bit of interpretation here, but I'll make the call right now that almost all of these people leaving the downtowns to start commuting for free were the poorest, most marginalized members of these downtown societies. Now, of course, after more than a year and a half, but once these people were gone, they now have reinstated fares, and lots of marginalized people are now saying things like, it is too difficult for an average person to get around with public transport. Now, that was true always, but it was hidden over the last couple of years by this free fare policy. Bus ridership in all of the same cities we mentioned are all falling back very quickly, surprisingly quickly actually. I'm willing to bet several people are losing their jobs because they moved to the suburbs relying on this free fare policy. Now that it's gone, they have no choice. They cannot afford to continue working where they were working. And so yes, first the poor people get pushed out of the cities, and in a surprisingly quick turnaround, many of them are probably being kicked out of Connecticut as a whole. For Bankwell Group, if they're smart enough to notice that this is happening, then they can be more confident about structuring their bank to focus on the efficiency that very wealthy client base. Now, a kind of small-time newspaper called the Connecticut Mirror was reporting around the same time that the bus fare reenactment was creating a lot of controversy. They suggested that Connecticut actually was lagging behind the U.S. in job and income growth. Job growth is 3.3 percentage points lower than the national average, and according to this one study, real wages in Connecticut have actually decreased since 2019. In particular, one of the major factors that explains this is that, statistically speaking, Connecticut is one of the most wage gap friendly states. Things like women earning less than men. Through that lens, Connecticut is ranked very, very much at the tippy top. Now, according to the Yankee Institute, all of these different figures are leading most researchers to conclude that Connecticut's population change during the COVID is mixed. And that's a fair way to describe it, but it's mixed in a much more extreme and straightforward way than pretty much any other state as far as I can tell. Without many people reporting it, Connecticut has massively screwed over its vulnerable and marginalized populations. First, giving them tons of free stuff during the 2020-2021 emergency, then convincing them to leave the downtowns, ultimately opening itself up to the largest number of startup businesses in its region, the fastest growing GDP in its region, all while seeing its number of filled jobs actually decrease and real economic wages stay at a less than 0% growth rate. Very successfully, aggressively, and brutally pushed a massive fraction of its marginalized and vulnerable populations out of the state, and especially out of its downtown cities. From now on, when we say migration trend effect, that is what we are talking about. Through no spending or effort of its own, the customer base that Bankwell Financial Group has been serving in its hometown state has massively adjusted towards being wealthier, more financially literate, more affluent. And this is the sort of major economic shift around them that can be allowing them to be generating much higher returns than the majority of banks in its sector. In the latest quarterly press release, our strong second quarter reflects an acceleration of positive trends which have been building. Notably, our net interest margin is increasing once again, and there is a very robust amount of small business loans growth. The combined results of all these shifts is that the company's baseline return on average assets has nearly tripled in the last year, and the company expects continued improvement to their profitability and efficiency as the current year progresses. All of this is thanks to what they call higher quality deposits. And Bankwell Financial is so excited about these higher quality deposits that they have now introduced a total of 5 brand new deposit-focused private banking teams. Now, for those of you that don't know, private banking exists only for the most wealthy and privileged clients. Given how teeny tiny Bankwell is, for them to start with 5 brand new teams all at once is a major pivot. The shift in demographics is so thorough and extreme that the chief executive officer genuinely thinks this is only early days of the impact. And so here is Bankwell's personal banking website, mybankwell.com. It is, of course, dedicated to making a difference. You can see a very well-dressed, very beautiful and happy minority being serviced by an equally beautiful representative. Now, hopefully you guys will just take my word for it. Maybe some marketing majors could reinforce what I'm about to say in the comments, but this color scheme, this type of buttons they have here, the Let's Talk, and especially the women that they chose to put on here, all of this is geared to a very specific type of affluent white man. The top products they're marketing are commercial lending, digital escrow, savings and CDs, which are traditionally in banking known as sort of the poor people products. Those are literally at the bottom of the page. And I don't want to hammer on this point so much, but I just find it a little bit funny. Beautiful artwork. Even on their front page, they're saying, "You're ambitious, so are we. Let's reach your goals together." I don't think I'm crazy to say that you're not going to see banks targeted towards poor people saying things like, "You're ambitious, so are we." I mean, it's very clear that Bankwell knows their customer base and what they're benefiting from. Returning to the financial statements, the annual report, any one of you that have invested in banks before, that have tracked things such as bank asset quality or capital ratios, I want you to pull into your head the sort of numbers you would expect to see, even at a pretty good bank. Non-performing ratios of 3 to 5%, etc., etc. Well, here at Bankwell, looking at asset quality ratios, we're seeing non-performing loans make up less than 2% every single year, sometimes less than 1%. Past due loans to total loans, very low as well. net charge-offs to average loans. This is a stricter statistic than you would usually see. And despite being stricter, they can barely put anything on here because they get so little charge-offs. Bankwell has a customer base that essentially always pays them back and on time, almost completely eliminating the major cost of the majority of banks. If you're a bank that can be so sure your customers are going to pay your loans back and on time, well, then you're basically a bank with superpowers. Bankwell's superpower is its ability to massively increase tangible total shareholders' equity while actually repurchasing and decreasing the number of common shares. If they keep this up, then the tangible book value per common share can continue to grow and grow and grow and grow. And its risk-weighted assets can be almost identical to its reported book value of assets. That's insane. And it essentially means that if you were to sort every bank in the US by efficiency, Bankwell would have to be certainly in the top 10, very near the very, very tippy top, maybe even the most efficient bank in the country. Every penny that shareholders provide Bankwell is being used not just once, not just twice, not just 3 or 4 or 5 times, but is literally being loaned out nearly willy-nilly at the very, very edge of what is legally allowed. And the bank is barely even sweating. Bankwell could literally handle double or triple the loans because of how amazing their customer base is. There's no stress in running this bank. If you like this video, please leave a thumbs up and consider subscribing or sharing with your friends. I share a Sage Seeds AI recommendation and validate the value behind those recommendations every month. Those videos come out the first of every month, but then on the 15th, I do technical update videos where we actually see how these specific stocks are performing over time and how easy or difficult it is to hold on to them. Thank you for watching, and I'll see you in the next video.